Welcome back to part two. Well, we're going to take a little look, keep going on this topic. And I left you last time with future borrowing capacity. And when I went to the 10K of Steel Dynamics, I found that they have this revolver. Now, I talked about some of this in liquidity from a perspective of liquidity, but I'd like to now talk it within the potential of the capital of the company when we evaluate it. So they have a $1.2 billion line. They got current outstanding, a letter of credit, which is trade related. The maturity is June 23. Secured substantially all assets. They've set terms, leverage ratio, minimal EBITDA levels. And then when we look at the whole thing and see how the companies do it, you'll find it's very similar to what we're doing. And if you're looking at the capitalization of that, is they are discounting essentially their accounts receivable and inventory, saying they're really not part of the capital. So what they're saying is you have capital when you throw everything in, and you can see that they have a flexible capital foundation. But look at the cost of this. So if we got them with senior notes at 5%, 5%, 4, 5, is there an opportunity to refinance some of that debt? Now, they don't have any maturities until 21, but they have the opportunity to call some of these notes. So what may be the best thing for them to do when we're looking at the structure is to refinance these at a lower rate. $700 million at 5% is $35 million a year in interest. So they could reduce that substantially. Important thing when we're looking at this is this flexibility, is they don't have a massive amount of debt maturity this year. As you move forward in 21, they will. So then what we want to do in this, keeping this, is to look at the capacity to service their debt. Because if we're going to do a couple things. Can they service this debt? So we're going to look at what the nominal rate of the debt compared to the cost of capital, weighted average cost of capital. Is the spread sufficient for the risk? What's the firm's ability to pay back debt? We could use two ratios here, times interest earned or a debt coverage ratio. Now, this one is pretty standard, but the debt coverage ratio, what we're going to find is that a lot of this is in the notes to the financial statement, and it may not be what we showed in the example that I gave you. So this is specifically defined in the notes for the company. If it's not there, then you can use what I have used for Steel Dynamics in the model. So here's times interest earned, and that equation is basically you start with earnings, you add back interest, add back taxes, that's IPIT, earnings before interest and taxes. You look at the interest, and you see that they have earned 13 for every dollar of interest. They have EBITDA of 1379. So that's a strong ability to service their debt. If we go back here, this wasn't really good. So these 2 years are not good. What we're seeing is a trend of the firm being able to increase their capacity to service their debt. It reduces the risk associated with the debt, because we could see that they can clearly pay their debt, and what we've been doing, what we did in liquidity, is we stress tested some of that. Fixed charge coverage, and that is, again, many fixed charge coverage, another very important one, especially given that a lot of companies will have fixed charges in addition to interest that have to be paid. And we want to see what's the fixed charge coverage. Is it strong? Is there a sufficient earnings to support the fixed payments? Just like it is, can we pay the interest? This is the only difference between times interest earned and fixed charge coverage is what's included in the fixed charges, and then we add back depreciation. Now, Depreciation and amortization is non-cash expense. Okay, so here we start with the EBIT, which came right from here. Then we've added back depreciation and amortization and come up with $2 billion. So EBITDA is earnings before interest, taxes, depreciation, and amortization. Then we see what their fixed payments are. Current portion of long-term debt and lease payments and interest. These are the traditional fixed charges, and we can see that they have a fixed charge coverage of 13.68. Now, with additional disclosure that has been developed over the past couple of years, companies now disclose what their fixed payments are in the coming up year. They lay it out by year because that's important to be able to evaluate the company. Say, hey, will they be able to support the fixed payments? Now, fixed payments could include, clearly does the current portion of long-term debt, interest, lease payments, but also some contractual obligations that they may have to pay. And they use it that way. But again, we look at the company, what's the trend? We see it getting bigger, it's getting stronger. So that's what we're looking for. Well, what are we looking at? Well, we're trying to find an optimal structure. So we start this by computing all the ratios for capital interest, then asking the question, is the firm highly leveraged and thus more risk and limits to growth? Do they have too little debt and not taking advantage of the leverage? And what's the relationship between the debt service, fixed charge, and then go back to cash flow? Does the firm have enough capital to grow? That becomes the question. We're also at this, what's the effectiveness of equity? How well are they using the investor's money? Is there an appropriate rate of return that is being earned for that can attract additional capital? Well, generally, the return on equity is net income divided by average common equity. Okay? Straightforward, expressed as a percentage. Then, that's one. So we're looking at the effectiveness of that. What is the return on equity? Is there a threshold? We then got to take a look at average cost of capital, because each component of capital, as I said previously, has a cost associated with it. That's referred to as the component cost. The weighted cost of capital is the weighted averages of the component costs, and it's referred to as the weighted average cost of capital, or WACC. What factors influence that? A lot of them are uncontrollable. Market conditions, interest rates, who knows? Market risk premium. Does the market see this company as strong or weak? Tax rates, when we saw from 35 to 21. Controllable factors by the company. What's their structure policy? What's their dividend policy? What's the buyback policy? How do they make a decision on how to make investments in people, plant, processes, technology? Firms that have riskier projects generally have a higher cost of equity. Expectation is higher, so are the risks. So essentially, when we compute the weighted average cost of capital, which you completed in 311, so this should be a review, is you take the long-term debt, and what's the interest expense? You get a pre-tax rate. Remember, you get a tax benefit. So the overall cost of debt for the company, Steel Dynamics, is $425. That's 42% of their capital. So the weighted cost of debt is 1.8. 4.25 times 42. Then there's the cost of equity. For purposes of illustration, I've used 15. I ask you to do the same. And that's 58% of capital. 58 times 15 is 864. And the current cost of capital is 1044, 992. So we're going to use that to say that if you're investing in a project, what's the premium against that? This is what you need to break even overall. Now, if you have different tranches and you were working within a company, you'd probably do this at a significantly more detailed level. You could have preferred stocks, different types of debt. Steel Dynamics has a fairly straightforward structure as we look at it. So we look at projects and say, what are we going to do? So that's one. We can say, is it producing a return that's sufficient to cover the cost of capital? So if we have a 5-year average cost of capital of around 10% and a project is only going to make 5, we wouldn't do that. Okay? But if the project is going to return 20%, that's higher than our weighted average cost of capital, and you could do it. Now, you can do this retroactively, historically, which is where the historical piece comes from. But if you're going to issue a new piece of debt, you would do the same thing. Okay, same concept. The next one, and this is one that I think is becoming a more important return, is the return on invested capital. And that's NOPAT divided by invested capital. So each one of these becomes a component because we're trying to say what's the return on the invested capital. Okay, and that NOPAT is earnings before interest and taxes less the EBIT times the tax rate. Okay, then for invested capital, we take long-term debt, capitalized leases, equity, and we subtract out goodwill and cash. This is where companies that have been on big acquisition sprees and have a significant amount of goodwill, that reduces capital. Okay, and this is a key thing as we move forward. It's what is the return on invested capital, and we can see with Steel Dynamics, EBIT 1746, tax rate 25%, NOPAT $1.3 billion. Now we look at debt, equity, take out goodwill and cash, and the invested capital is $4.3 billion. So they generated $1.309 billion in NOPAT and gave us a return on invested capital of 30%. That's good. So what we want to see is the increasing trend, and we want to see a very positive number. We need to relate it to our risk premiums that we're looking for. Now, some of your companies may not generate a return on invested capital that's sufficient, and that's where you have to go back and look at that mix of capital. So if we're looking at it on a very theoretical basis, 2% is a threshold. Below that, not good. You're destroying value. Okay? So anything in ROIC below 2%, not even worth being in business. So if we're looking at it and compare it to weighted average cost of capital, the difference between the ROCI, return on invested capital, and WACC is return to equity. Okay? So that is giving us a little